Equity SIPs have historically given good returns, but over a 7 to 10 years time frame. Yet many of us have given up halfway. This is because we are not ready for the volatility and a phase where the returns are low, especially in the first 3 to 4 years. This chart here seems very busy. Let me simplify it for you. On the left half are returns generated in the first 3 to 4 years of investment, be it lump sum or SIP. You will see more red and yellow, indicating low returns in the range of 0 to even minus 20% in some extreme cases. This happens for investments that are held for less than 3 years. As you move to the right, all the investments held for more than 5 years suddenly start showing extremely good performance. The returns quickly start climbing to even 15% per annum. So the investors who have experienced low returns are those on the left block who have been disappointed and who stopped investing in the first 3+ years. And investors who have had a good experience with great returns ranging from 12 to sometimes even 20% annualized are those on the right block, those who simply held their investments for 4 years or so. There is a clear demarcation, as you can see, somewhere at 3.5 to 4 years, and at that line, the performance and experience seem to tip for the investor. I call this line at about 3+ years the slope of disappointment. This is a disappointment phase where you see returns in the range of 2 to 5%, sometimes even 0, or when there is extreme panic in the market, it is even temporarily negative. This happens, as you see in the chart, in every SIP investor's journey. Most of them give up in this phase of disappointment, which is in the first 3 to 4 years. If you had just extended this by a year or so, his investments right from day one of waiting would have returned handsomely in the range of 12 to 15% annualized, as you can see here. Let me also tell you why this happens. The economy goes through a cycle of boom and bust. Most of us think about investing when there is extreme optimism and enthusiasm of the future. We wait for markets to rebound and reach a high before investing our money, as that gives us greater confidence since everything looks good now. So we invest in a phase where the markets are accelerating and euphoric, but that's too late as growth soon flattens, which is part of the economic cycle of boom and bust. The investors then feel uneasy and see their investments lose value. They are first in a state of denial, soon pessimism follows, and so does panic. Somewhere in this phase of pessimism, most investors sell off their investments. They do this at a loss as they have entered at a higher value and now selling in panic at a lower level. This is what I call the slope of disappointment. The market continues to correct further, giving a false relief to investors who have cut their losses earlier. The last man standing also sells now, and that makes the bottom of the market as there are no more weaker investors to sell. From here the market recovers with hope and a relief rally. All the while, the investors who sold at a loss are waiting on sidelines. The market regains all its losses and starts making new highs. New investors again start getting in at this level when there is again optimism and enthusiasm about the future. And the cycle repeats and investors fall at the slope of discontent. Only if an investor is able to hold during the slope of discontent would he be able to make money in the markets, which means he has to be able to see his portfolio giving low or negative return for a temporary period of time. He has to have the mental fortitude to see his investments go negative in the first few years, and then the magic works. This is the historic return of SIP when held for a period of 5 years. It is in the range of 12 to 15% or more. In summary, superior long-term returns come down to patiently enduring these periods of underperformance, especially in the first 3 to 4 years, and developing a mental attitude to see the slope of discontent very positively. I've taken this data from the research of Funds India. The charts are indicative to explain the concepts and not to scale of real economic movements. The real slope could be lesser negative or positive. It could be longer or shorter. If you like this video, please do like, subscribe and share it with your friends. Thank you.